And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
We're in the midst of a very long bull market cycle, one of the longest in U.S. history. So it started in 2009. And we have not violated any bullish trends since 2009. It's been a very, very long secular bull cycle. So we're currently 15 years into this, 16 now. And normally, you know, kind of these full market cycles, they can last around 20 years. So, you know, we're at the longer end of one of these, what we call a secular cycle. Now, secular cycles are important to understand. Going back to 1900, you have secular bull markets and you have secular bear markets. And these are periods where markets trend positive. A secular market is when the price of the market trends in a direction over time. So if it's trending higher over a period of time, that's a secular bull market. If it's stagnating or declining over a long period of time, that's a secular bear market. And if you go back and look historically at markets, we cycle from one cycle to the other over time. And so you had from 1871 to 1901, you were in a secular bull market. From 1901 to basically about 1920, you were in a secular bear market. Then it was a bull, then it was a bear. Bull, bear, bull, bear, bull, bear. Well, now we're in a bull, right? And this all is a function of valuations over time. So when valuations are fairly cheap, that's typically where you end secular bear market periods and a bull market starts. And when valuations get very elevated, that's typically when bull markets end and bear markets begin. But again, this has been a very, very long secular bull market that we've been in. Now, and again, to bring that chart back up real quick. But what's important to note is that, and this is kind of that purple dashed line, is that full market cycles encompass both. Because again, for every bull market, there has to be eventually a bear market. Bull markets don't last forever. Eventually, you're going to have a reset of some sort that corrects valuations. We go through a period of time where markets reset themselves, and this is regardless of Fed intervention or anything else. It's just how markets work. But when you go through one of these resets can last for quite a long period of time. And again, that doesn't necessarily mean that prices only go down. If you take a look from basically, after 1929, you got to, kind of 1933, and then the markets rebounded. But really, after 1929, the markets just went nowhere till 1948. They just very long period of time going sideways. The 60s and 70s, you saw, kind of a bigger decline situation. But again, you get the idea, right? 2000 to 2015, markets went nowhere. So these secular bear periods don't necessarily mean that prices just go down for 5 or 10 years, whatever they are. It just means that they just kind of go sideways. This is why we talk about periods of no return. You go back historically, look at 2000 through 2013 as an example. Your return was zero. Right? A lot of volatility in between. Had some bull markets, had some bear markets on a cyclical basis. But again, your net return over 13 years was zero when you got to that point. So that's what a secular bull market is, just very, very low rates of return. It doesn't have to be negative. You got to have a 2% rate of return over 20 years, right? It's still a secular bear. So the point is that as when you're in the middle of these secular bull market periods like we are today, it's easy to forget that the market has a full cycle to it. And that eventually you'll go through one of these periods where markets will just just gyrate sideways for a while. And there's going to be some big drawdowns, there'll be some rallies, there'll be some drawdowns, some rallies, drawdowns, some rallies. And at the end of 10 or 15 years, you go look back and go, wow, I made no money. But we're not there yet. But that is what is on the other side of this very long period of exceptional returns that investors have experienced over the last, 15 years. It's been a great market. It's been easy. Just throw money in markets, it just goes up. Here's a chart of the real S&P 500 index going back to 1871. Now, this is inflation adjusted price of the index. And what you'll notice is the red lines are these full market cycles. And what you'll notice is that from the beginning to the end of these full market cycles, you wind up basically where you start, despite the fact of all the great stuff that happened in between. So, for instance, at the end of 2008, you were back to where the peak of the market was in the 1960s, right? You just kind of wiped out all those gains. And that's what happens over time. And again, so if you take a look at where we are now and you kind of take a look at kind of historical tendencies, we'll wind up back at the peak of the market in 1999, 2000, in theory. Now, that's just in theory how it works. It doesn't mean it's going to work that way, but that's about 2,200, right, on an inflation-adjusted basis. So, that's a fairly substantial secular bear market if that occurs. But that's historically how things have happened, and I'm not making the case. I'm not saying that's what's going to happen. I'm not saying the markets are going to crash tomorrow and you're going to 2,200. I'm not saying that at all. I'm just saying, look, in normal full market cycles, this is what occurs. And again, you can end up higher. I mean, we could go through a secular bear market and wind up exactly where we are today, right? But just 10 or 15 years out, and your return will be zero. That's the point is that these cycles tend to really weigh on long-term returns. And it's important to understand that these cycles do have a rhythm to them. And part of this is understanding kind of market structure. There's what's called the Wycoff cycle. And what the Wycoff cycle talks about is in these full market cycles, you go through kind of four phases. You go through the accumulation phase, you go through the markup phase, which is where we are now, and then you go through the distribution phase, and then ultimately you get back into the decline. So that would be the bear market side of this equation, right? So we're still in the bull market side of this. We're still obviously in the markup period because, right, we're just ramping up everything right now, marking everything higher. So we haven't got to that period to where we're starting to just stagnate, right? And we begin that distribution phase in the markets. We don't see the evidence of that just yet. But when you start seeing that early distribution, that's when you want to start being a little more conscious about your risk positioning. And we're, again, you just got to be careful with this. Understand this is very long. This doesn't happen overnight. These things take this, when you're talking about secular cycles, these are very long periods. This is a decade or more that this stuff occurs. Again, we're 15 years into the first half of the cycle. So again, very, very long. So you don't look at this chart and go, oh my gosh, Lance just said the markets are going to crash next year and it's all going to be over. I'm not saying that at all. Don't do that, because the distribution phase could last several years by itself. And markets just kind of go up a little bit, they go down a little bit, they go up some more, they come down a little bit, and then you just see this distribution underneath the surface before you actually get into the decline phase. And that could last a couple of years. So again, this is not market timing stuff, right? We're just talking about understanding how market cycles work over time and understanding that there's a very long process to this. And I've just gotten, I've seen so many videos lately of people getting sent, people sending me videos. The AI bubble is going to pop. It's all going to be over. Markets are going to, crash, for this reason, that reason, other thing. And there's no evidence of that right now. You're very early into this whole AI adoption phase, right? If you go back to the 1990s when we were adopting .com, that was a 5-6 year phase. So this AI adoption phase can, sitting there calling the top to AI here is a bit of a fool's game, because you don't know if AI is going to get adopted the way that everybody expected to be adopted. If you're having all this AI capex, this cycle could last for 2-3 more years before you eventually get to the real crux, right, of AI. Is it going to work or is it not? We're not going to know that next year. We may not know that for a couple more years, right? And a lot of people are pointing to the, Oracle put on all this debt to go build a data center. Yeah, they did. Credit spreads are going up. That's an early warning sign it's all going to crash. Be careful with that. That stuff takes time, right? It may be in a little bit of a short term. You may be getting some volatility, but there's no evidence of major cracks in the system right now. So again, it's stuff we definitely pay attention to, right? I'm not saying don't pay attention to that stuff. You should. But just don't extrapolate it to mean that something's going to happen tomorrow, because that's not what that data suggests. So coming back to kind of our analysis, let's go look at some full market cycles, just to kind of get some understanding of context. So this is 1992 through 2003. See, this is the point I'm trying to make about the markup and distribution phase. The accumulation phase occurred from 1992 through 1995, and from 1995 to 2000, you had the markup phase, right? And then the distribution phase started occurring, and that lasted a couple of years. It lasted through 2001 before you really got into the decline phase of the market. So again, my point is that these can last for a while. When you start getting into the distribution phase, you start getting a lot more choppy in the markets. Markets can still be making gains, but you're getting a lot more volatility pickup. Let's take a look at another one here. This is 2003 through 2009. You see the same type of cycle accumulation. You see the markup going into 2007. You got the distribution phase, and then Lehman files for bankruptcy, and you get your decline. But these cycles, again, they're very apparent, and we're clearly still in the markup phase right now. If you take a look at, this is 2010 through 2025, where we are now. You got your accumulation, and you've had this big markup now that started in 2020. So we've not started that distribution phase yet. And again, if you take a look back at those previous charts, that distribution phase can last a couple of years. So again, just be a little bit cautious, with your, being overly bearish with markets. And this is kind of the thing that becomes most important about managing money is we have to navigate the market that we have right now. And it's great to have these views that are bullish or bearish about the future. If you're ravenously bullish, that's awesome. Just understand it will end. If you're mega bearish, just understand that the bullish case has a lot of tailwind to it right now, and that bullish tailwind can last a lot longer. So, if you're trying to short the market and do a lot of things like that, it may not work out well for you right now. Eventually, it may pay off, but you can lose a lot of money between now and then being short this market right now, simply because of momentum, buybacks, all the other things that are going on. Eventually, you'll be right. And that's what the market tells us, is that historically, we're going to go through a period where, again, returns are going to be very low. This is a long-term chart. This is the real return, inflation-adjusted return of $1,000 investments with dollar cost averaging. So it's just assuming you're dollar cost averaging into your portfolio every single month, right? Going back to 1900. Even with that, you had very long periods, 6 years, 15 years, 12 years, 13 years of no returns, even with dollar cost averaging. So again, you look at that chart and go, well, yeah, but if you just stayed invested the whole time, you did great. Yeah, the problem is you don't live 125 years. So it's important to understand where you start. So if you're starting today, as an example, with valuations where they are, you run the real risk of having a 10 or 12 year period where returns are near zero. And that will certainly hamper your retirement planning outcome. So you can't ignore fundamentals, right? You can't ignore valuations. But what's really, really important is to understand full market cycles. And again, this isn't timing. You can't time with this. You cannot use valuations as a timing metric. It'll completely wipe you out. So this isn't a market timing conversation. This is understanding how market cycles work. Incorporate that market cycle idea into your investment policy to help you manage risk over time. And again, this kind of goes back to our conversation earlier about Berkshire Hathaway. Berkshire Hathaway's like driving the dad's old Pontiac. Warren Buffett's lost his touch, right? He's underperformed the last few years. Yeah, of course he has. You want to bet against that man when the market does turn? Just a question. Sometimes you own assets in your portfolio that don't make a lot of sense today. I should just have everything in AI stocks. I'd be making a killing. But if I do that, when you get a downturn, you get wiped out. My goal is to preserve capital over time. I want to win the long-term game. I want to grow my assets today because I want to win the long-term game tomorrow. And survivability is what's so important. You know, it's okay to be right during the first half of a full market cycle, but it will be the death of you to be wrong during the second half. There was a really great quote. John Hussman once wrote this, and it's important because he's right. It says, put simply, most apparent opportunities to obtain investment returns above zero in conventional assets over the coming decade are based on a misunderstanding of valuations. Total returns and historical yield relationships. At current valuations, virtually everything is priced for a decade of zero. The unwinding of these speculative extremes is likely to be chaotic and will likely occur over a shorter horizon than investors imagine. That chaos, driven not by central bank tightening, but by an emerging default cycle, will usher in fresh investment opportunities in conventional assets where presently there are none. Looking beyond the near term, my view is that a permanently high plateau is unlikely, and we will instead see a violent unwinding of recent speculative extremes over the completion of the current market cycle. Even if central banks ease aggressively, as they did in 2000, 2002, 2007 to 2009, corporate income growth and profit margins will narrow. He concludes that saying the completion of this cycle won't arrive because of central banks suddenly becoming enlightened enough to abandon their recklessness, because they won't. It will arrive precisely because they have sustained yield-seeking speculation for far too long already, and because they have amplified the vulnerability of the debt and equity markets to normal economic fluctuations, and because the consequences of this fragility are now fully baked into the cake. That is the important thing. Now, he wrote this a while back, and he was wrong at the time. But what he says is correct. The problem with the markets, and again, when he wrote this was several years ago. He wrote this, and he's been wrong for several years because of how markets work. And again, market dynamics, momentum, too much money chasing too few assets, those type of things can drive bull markets for a very, very long time. And that's the important part of understanding the full market cycle. It will eventually end. What causes it to end, we don't know. But they do end. And the question is can you survive when that occurs? And will you know what to watch for? And this is why understanding accumulation, distribution, markup, distribution, decline, understanding that cycle of the markets is so important because it repeats in the markets over and over and over again throughout time. And it's going to happen again. Again, we're still in the market phase, but again, that will eventually come to an end. So, this is what's important to understand. Again, it has nothing to do with timing. This is nothing you can apply to your portfolio today. This is nothing out here that says you should go out and sell a whole bunch of stuff because Lance said full market cycles are coming. No, that's not the point of any of this conversation. It's just to understand how markets work over time and to be cognizant of how valuations do work over time. We do have high valuations, but we still have economic growth. We still have earnings growth. We still have a lot of things that are supportive of markets, so valuations remain elevated for a while. But if something happens, that's where you have to manage that risk.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economics Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Lebowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, good morning. Welcome to the show. Danny, good morning. How are you?
Hey, morning. Great.
Good. So before we get into our conversation this morning, and just another topic that came up is we touched on yesterday a little bit about the 50-year mortgages, which are just absolutely crazy. But another one is this idea of Trump had floated out this idea the other day about a $2,000 check, right? So it's a dividend check from the tariffs. And there's kind of an interesting, so there's two things about that. So first of all, the tariffs are up for review at the Supreme Court. Did Trump, the question is simply this: did Trump have the executive authority to issue a tax on foreign countries when taxes are by definition a function of Congress? So that's really the question before Supreme Court is can the president usurp Congress's authority to implement a tax using executive privilege? So we'll see how that turns out. Right now, the betting odds on the outcome of this are pretty low, that most likely the Supreme Court will rule against the Trump administration and say, no, you need to go through Congress, which means that he'll have a period of time, most likely, to go back through Congress, get tariffs implemented into law as a tax, and then go from there. So we'll see what happens. But here's the interesting thing. So President Trump announced this idea is like, hey, we're going to send a $2,000 check to households, unless you're wealthy. And that'll be a tariff dividend. So it's kind of a smart move if he did this. It's good and bad, because it would be very, very hard for the Supreme Court to come back and try to claw back $2,000 from every household in America to refund tariffs. Right now, that money's just sitting in the Treasury. And so basically the Supreme Court could say, hey, you need to refund all these tariffs and send them back to the countries you collected them from, because they were collected, not illegally, but they were just not collected properly, is a better word. And so you have to send the money back. And so that would require debt issuance. We'd have to refund that money. So it'd be a very different thing, though, if that money was already sent to households. So we'll see. But there's a lot of excitement about this. It's like, oh, great, this is kind of going back to what we saw in kind of 2021 and 2020, where we were sending checks to households. Well, the results of that were not great, if you remember. You create a lot of inflation. Now, there is a difference. The economy's fully open now versus then. You had a shut down economy and no supply, and so prices went through the roof because everybody was trying to buy something with a $2,000 check and create inflation. A little bit different this time. You probably won't get the inflation push if that actually happened, but you would certainly make people very happy. But already, though, Scott Besson has pretty much shot this idea down. He said, oh, no, the $2,000 dividend is going to come in the form of either the tax cuts, the no tax on tips, the things that we've already are passing through Congress. That's how you're getting your $2,000. So Scott Besson's pretty much already kind of laid the case out that no, you're not going to get a $2,000 check, most likely. Now, again, anything is possible. The good news is, I should say that's the good news. The good news is anything is possible. You might get a check. The reality is no, you probably won't. And again, the outcome of that on inflationary pressures, et cetera, because this is just the way the economy works. If the marketplace, if the economy knows that you're about to get, I know Danny's about to get a $2,000 check, right? And Danny has 3 kids and a very expensive wife to maintain. And
if she's listening, you're in trouble. Oh, man.
And so immediately, Danny's going to go out and spend his $2,000. Well, he's going to go out and spend it on new shoes for the kids, whatever, right? And immediately, the shoemakers are going to go, I know Danny's got $2,000. Price of my shoes are going up, right? So it will cause, when you send out $2,000 checks to households, it will cause some rate of inflation. Now, it'll be very short-lived because once the money's spent, it's over, right? And so prices will come back down as demand slows. These things are never a good idea. They're great for getting votes or getting approval ratings up, those type of things. But economically, sending out, and look, and there's been plenty of studies now about universal basic incomes, complete failures. They do not work because it does not provide a better standard of living. You know, the idea of universal basic income is I give Danny a basic income so he can go do other stuff that he likes. Well, the problem is the entire economy shifts to that universal.
Raises the poverty level.
Exactly.
Yeah.
So it increases the poverty level and, again, creates no incentive to work because I'm getting free money. So these things are never a good idea. Economically, historically, they never work out well. I suspect that, and this is why Scott Bessent came out and made the comments he did, is like, oh, you know, you're already getting your $2,000 refund through no tax on tips, no tax on Social Security. Those, and we need to talk about that, Danny. No tax on Social Security. That's how you're getting your money back. That is a better way to couch this than sending out $2,000 checks to households. Anyway.
Well, he's floated these ideas out historically. I mean, every couple of months. I mean, he had a Doge dividend. You had all of these different ideas that he floats out. They sound great on paper, but like you mentioned, it raises the poverty level. Prices go up. So you do see that small inflationary push, but this is a little different than what we saw during the pandemic because it's not something that is continual, right? It's just that one time you're done. And the economy's not shut down, right? You don't have the supply and demand impact. So much, much different. You know, what else do we have right now to see what interest rates may or may not do? I think what is it, 60% odds they hike rates, the Fed's fighting.
Yeah.
And today we've got, what, a 10-year bond auction?
Yep.
So,
yeah. But again, you know, my whole point is that the question is just, you know, could we address this on our show? I'm happy to do it. And Danny's right. You know, we've heard a lot of things from this administration over time. Most of this stuff will never come true. So I would not be betting the future here on a $2,000 check. So yeah, don't spend it yet, right? This is one of those things that you don't spend it till it's actually in your account. So just. All right, welcome back to the show this morning. Michael Lebowitz joining me as well. So, a couple of things going on. Again, is kind of just, you know, kind of talking about markets, the economy, what's happening. Of course, the big concern right now is whether or not the Fed's going to cut rates at the next meeting. Of course, right now, from what we're seeing on kind of most of the front is that we are you know, seeing economic data slow down enough, at least from some of the off-the-run indicators, that we're very likely going to see another rate cut by the end of the year. There's really nothing kind of stopping the Fed from cutting rates by the end of the year, at least at this point. Of course, the big question becomes, again, you're cutting rates into a period of time where expectations are high that we're going to see an economic recovery next year. In other words, the economy is going to start gaining strength. This is the expectations. I'm not saying this is a true fact. I'm just saying the expectations are we're going to see an economic resurgence next year, primarily due to all of the build out of AI infrastructure next year. That's going to be a very large multiplier impact. And there's a lot of people running around right now going, oh my, these companies are spending all this money on AI. And that's true, they are. But it's going to create a lot of economic activity. You're talking on terms of about $5 trillion worth of spending over the next 4 to 5 years. That has about a 3 to 4 to 1 multiplier. So you're talking about a 15 to $20 trillion impact on a $25 trillion economy. So again, on a real basis. So, that's going to have a major impact on what happens in the rest of the economy and also help and also drive a lot of what happens in the markets because all that money is going to get spent by the people that are receiving those funds from the build-outs, right? So all the infrastructure goes to the construction workers, et cetera. They spend money in the economy. That creates more revenue, more economic activity, so forth and so on. So there's going to be a lot of stuff that's going on as we move into next year. And the question is, you're cutting rates and loosening financial conditions in that environment. So you potentially run the risk of causing an overheating in the economy, a pickup in inflation, those type of things. Again, rising inflation in an environment where you have stronger economic growth is not a problem, right? So again, that you should expect higher inflation. If you have robust economic growth, 3-4% economic growth, you should expect 3 to 4% inflation. Those two go together. But so then that's not a bad thing because wages will come up. That's going to happen as well. And again, even the White House is now seeking to raise wages for hourly workers. So we're starting to see a push, right, for higher wages. But again, it's just a very interesting situation that we've got the Fed on this path to cut rates, and the markets are expecting a much stronger economic output yet next year. So again, how this eventually works out is going to be interesting, because normally the Fed's cutting rates when the economy is really, really weakening, and they're cutting rates to try to restart economic activity, or at least buoy economic activity. But that's not happening this time. So again, this also kind of brings us up to the point of recently the Fed just also announced the reduction of QT to zero. And that's going to end at this month. It's not like they said we're going to stop QT in a couple of months or the end of the year. It's like, no, we're going to end QT at the end of the month. So what's the rush? And for that, we'll talk with Michael Lebowitz.
Right. And you know what I was kind of thinking about, what would, if they made me the Fed chair, what would I do? How would I deal with this situation? And I think the answer is you manage liquidity to its minimum. So you don't provide too much. You provide enough so that the economy can go on, that the markets can function, but you start taking away enough liquidity so some of that excess uses of capital, like the speculation, you try to get some of that out of the market. And that's not an easy job. And again, the Fed has no clue really what the right level of reserves is. And if you just drop it by a little, it can have a big effect, big impact.
Right.
And same with adding it. But the point is, try to manage liquidity so the market doesn't know it's abundant, so that the banks allocate it better, that they allocate it towards the more productive uses of capital versus speculative. And if you can somehow take some of the bubble out of the market without the market crashing, you've done a tremendous favor for the U.S. economy.
Well,
for the people.
Yeah, the question could be could you restrict the flow of leverage from the reserve accounts of the banks to the hedge funds, right? Cut off that source of liquidity, or at least reduce it, right?
Yeah.
Right, and others, right? So, or at least reduce it. So if I'm loaning out 10 times leverage or 20 times leverage, whatever it is, you put a leverage cap at 5, right? 4, 3, whatever. Right. And that would certainly slow that rate of liquidity flow into the markets. It would certainly damage the financial markets, which is starving for liquidity even right now. But it's again, you could probably do something in stages to where you could reduce that liquidity flow to slowly kind of deflate the bubble and get kind of asset prices back in line with valuations.
Right. Right. And I'm not saying that's easy. That's an incredibly hard task. I don't even know how you would go about figuring out what those levels are. But like you said, there's 500 PhDs that must be somewhat smart. Maybe they can figure something out.
Well, apparently they don't. So we just keep we just keep running the same playbook over and over again. So it's just like, oh, there's a crisis, throw liquidity at it. So there you go.
Well, Lance, maybe you can move to DC and the two of us can go work at the Fed, figure it all out.
I don't have my PhD, unfortunately, so I think that's
fortunately.
Anyway, all right. That kind of wraps up the show for the day. Be sure and like and subscribe to the channel. We appreciate it very much. Also get by the website. Mike's latest article on the website now, realinvestmentadvice.com. That is realinvestmentadvice.com. The entire article about this liquidity issue in the markets, it's on the website, along with our latest article on money printing by the Fed, fact or fiction. That's also there, which goes into this whole idea of how reserves are created in the markets. So again, both of those articles, really good kind of good detail behind today's conversation if you need more to work off of. So anyway, that's on the website, realinvestmentadvice.com. Be sure and like and subscribe to the channel, and we'll see you back here tomorrow for the next edition of The Real Investment Show. Have a great day.